How does a bank decide whether or not to give a person a loan? And specifically, why do banks decline loans?
Okay. What I think, what's important for, people to understand is when a bank makes a loan, it's actually making an investment. No different than anyone making an investment. Because what's your biggest goal when you make an investment? Make money, obviously, but on top of that, what's the biggest goal?
You don't
lose your money. So when a bank makes a loan, how it decides who qualifies, who to approve and not is based on an analysis that's very similar to an investment. A lot of people think it's a hassle. Oh my God, you go to a bank, they ask for all these documents. When we ask for all this information, whether it be lending money to an individual, a trust, a business, whatever it may be, let's call it the borrower, right? When we ask for all this information, we're trying to gauge, based on guidelines that we have internally, what's the ability of that borrower to repay us. When we decline a loan, is because based on our analysis, now it's quantitative and qualitative. That means it's numbers and a little bit subjective, a little bit of like decision making, not based on numbers, right? But usually it's quantitative. It's all based on numbers. If you look historically, you can't afford to pay the loan, you can't carry the loan, we're not going to approve it because we don't have a level of confidence that we're going to get paid back, right? And also what's important for, I think, the general public to understand is when a bank, a depository institution like who I work for and like most banks in the country, right? We have a fiduciary and responsibility to be prudent and very, very careful mitigating risk with the loans that we make, right? Because whose money are we using to lend the money out? We're using depositors' money. Hence why we're so highly regulated, because we have to make sure that we're not irresponsible with other people's deposits and lose that money because it's depositors' funds. So we're so highly regulated because of that. And on top of that, the banks will have, like, just say here's the threshold based on regulations of how we lend. The banks usually put a higher threshold in their underwriting, credit guidelines, whatnot, because we want to make sure we protect those deposits. We want to make sure we protect the capital that we have when we lend that money, which is depositors' funds, so that we get it back. So when we decline someone, we've made a decision that based on our guidelines and our risk appetite, etc., that we don't feel that this particular borrower can pay us back, so we decline it. That's why.
Got it.